Today, we're focusing on US yields and the rapid incline that they've seen over the last couple of months. And then we're going to move on to whether gold has become a safe haven hedge again. And the trading takeout for today is going to be why you really need to understand the products that you're looking at. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So the US 10-year yield, the yield on US 10-year government bonds, has reached another high since 2007. It just keeps going up and up and up. And it really is showing that the bond market is entirely dislocated, in my view. I think the reason for this occurring is that, people are still pricing in the higher for longer narrative. They still think that interest rates are going to remain at above, say, 4%, 5% for quite a while now. And so that's letting the bond market just keep pushing higher. There are other idiosyncratic factors, but I'm not going to focus on those for now. But I think the base case here is that the US economy is doing better than most people think. It's allowing this view that there doesn't need to be a flight to safety in bonds to actually occur. People are selling off bonds quite heavily. Interestingly, though, it's the longer dated bonds that are selling off versus what has historically been the shorter dated stuff. And so, we're seeing that curve sort of revert quite heftily. We're seeing it come back quite a lot. And I think, the curve inversion that we've had over the last year or two, that normally comes before a recession. But the reversion is what really matters. So if we show here, minus USO2Y, we can show exactly what we're talking about here. So this is the curve reversion, okay, that's occurring. Recession never happens when it actually inverts. Recession happens here. So recession happens probably when we start getting above 0% again. The curve is still negative, but it's reverted almost, how many is that? About 85 basis points, I believe. So it's been a rapid reversion since the middle of 2023. And you could, maybe even run, let's say, a currency pair across this. I wouldn't say this is the strongest analysis, but there was something that happened in the middle of this year that caused, things to change, basically. So you can see here, this is euro dollar. Right when this curve started reverting is when the euro started to sell off. So this just shows you how closely related currencies and currency pairs are to bond yields. That's literally all that moves them. People want to argue with that, but it is all that moves them at the end of the day. There are just factors that influence yields to cause changes like this. So, the way that we're going, I would expect this curve just to keep reverting. And this is why also I'm bearish the euro based off of this. Excuse me. I really think that the euro is in for a tough time, regardless of the fundamentals going on in Europe. I think that's just more of a catalyst. What needs to be the focus here is the dollar side of things. And the dollar is influencing the key driver of the euro-dollar pair here. The euro fundamentals are very, very fixed. It's much like in Japan, where you've got the fixed, easy monetary policy. You just are then working against the counter currency and how that changes relative to the yen. So if yields start dropping in other countries relative to the yen, you know that the yen and their monetary policy in Japan is fixed. And so you're just working with the other counter currency. So if US yields start dropping, then you would probably sell dollar yen because you are understanding and certain that the Bank of Japan are going to remain pretty fixed. So this is the way that I'm looking at it, pure yield play, pure yield curve trade. What we're really seeing here is the dollar getting bid in a risk offish, I guess, or preparation for risk offish environment. And I think that's the way that we play it. I reckon the euro is going back to parity. There's been no calls for it yet. which is strange considering we're only 500 odd ticks away from it. But I would say the euro's going below and sub parity again. Again, I want to reiterate, it's never made a higher high after each cycle has changed, after each regime has changed. And so I really think that, that's probably one of the strongest plays out there as a general thematic of the yield curve and yield differentials. Rather than reinvent the wheel, here I'll just share something in writing that I think is absolutely bang on, very, very relevant to gold. So a lot of the time we talk about gold in terms of real yields. Okay, there's a negative correlation with gold and real yields. So if real yields are down, gold goes up, and vice versa. But in situations like now, when there's the start of a war or a conflict, let's say, that's going on, and there's a potential for dramatic escalation. I did speak about escalation yesterday, and these are the only things that matter, is when there's escalation and de-escalation. You can see it spelled out to you here. So Brent is, ex-hedge fund manager, worked at various different banks, HSBC, writes a fantastic daily note. It is normally for institutional clients though, but it's great if you can get a hold of it. And he's basically saying that gold as a safe haven generally is unreliable. However, there is a shortage of good safe havens right now. The yen tends to be a good safe haven, but at the moment it's clearly not. And what he's saying is that because there's such a shortage of safe havens, bonds aren't safe at the moment. No one wants to own bonds. Gold and the Swiss franc have become, those real safe haven bid potential candidates. And so if there is an escalation where Iran can get involved, and do you know what? There has been some chatter of this morning. Let me just get it up. He says, Iranian chief of staff says the continuation of Israeli attacks could result in the entry of other parties into the field. So there is a potential. But what he's saying is that if that does happen, then gold and the Swiss franc will go parabolic, as he says there. And, I completely agree with this. The counterpoint to this, though, is that if there is de-escalation, then they will get absolutely sold off and slaughtered in the short term. So your job as a trader is to weigh up the probabilities of Iran getting involved or some escalation occurring versus the de-escalation. It's really, really tricky to do because, I'm not an expert in it. I don't ever profess to be. And so what you probably have to do in a situation like this is think about, okay, what is my position sizing going to be? How much do I believe in this idea? But also, how easy could it be that the idea reverses and I'm wrong on it? Which would probably lead you to having to have quite a small position on this. And then if it does occur, if escalation does occur, you then need to scale in pretty quickly. It's a very, very tricky thing to do when you're doing event-driven stuff. It takes a lot of practice and a lot of intuition and a lot of bravery, let's just say bravery. And so, yes, it's tricky, can be done, can end up being a fantastic P&L addition. A lot of the stuff that I do is quite event driven, not so much in conflict, but more surprises on data and things like that. But yeah, I think this is just a mere bravery play where you keep your position small and you are trying to understand the changing and dynamic probabilities of escalation versus de-escalation. It's a very, very tricky thing to do. But it's why Twitter is so important, why having your adequate news sources are very important. I show you News Squawk there, fantastic edition. It's quite expensive a month per retail client. But maybe if you petition Axie, they can sort something out with them. But yes, keep an eye on the news, keep an eye on your position size and keep it small, keep it tight. And do you know what? I'd say in this environment, it's important to have wider stops too. Smaller position, but wider stops, giving yourself the ability to scale in. That is, pretty key. So here's a perfect example of perhaps not quite getting the products that you're trading. So I was on Twitter, and this is my Twitter, and I was having a discussion with this gent about the VIX and technical analysis, because the point was made that you can't do technical analysis on the VIX, which I completely agree with. The product structure of the VIX is not the same as any other sort of time series, let's put it that way. And I asked him, he was saying, oh, okay, I can, I can use technical analysis on the VIX. It works for me, blah, blah, blah. So I asked him, all right, well, that might be the case, but how do you actually trade it then? And he said, I'm balls deep in triple Q puts, which is NASDAQ puts, personally. Buying UVIXI is a fine trade for normies. Now, if you didn't know this, the UVIXI is a leveraged exchange traded note, which mimics the VIX. So it's an ETF, basically. It's an ETN, but an ETF is probably the best, easiest descriptor of it. That is leveraged on the VIX. So it's leveraged on a volatility product. Now, some of the best traders don't understand volatility. So saying something like buying UVIXI is a fine trade for normies, which is normal people, is a little bit stupid. And it brings across sort of a wider point as to why you really need to understand the products that you're trading, because sometimes you're able to get wiped out if you don't understand that the product that you're in is actually leveraged, or it's derived from something else. So I'll give you another example. Lots of people like to invest in uranium, and a ticker for that is URA. The problem with this, though, is that back in 2021 or maybe 2020, it was rebalanced to include a whole host of non-uranium related stuff. So people are buying it based on it, being a proxy for uranium, without realizing that there are actually other equities and other products involved that influence the price as well. Another example is USO. USO was an ETF which was focused on US oil. But again, it changed to incorporate a ton of stuff, and people just didn't realize this. And I think, understanding what actually goes into the products, especially when they might be margin based too, is absolutely vital, because you can really become unstuck when a simple bit of research can just aid you.